Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending November 8th, 2019. Everybody, I'm Preston Brent. Thanks for tuning in. Today's weekly theme, I guess, we're in a bullfight, everybody. You know, we've seen the Dow, the S&P, NASDAQ, Russell all up this past week. The leader for the week was actually the Dow. It was up 1.22%. We're making some all-time highs, except in the Russell. They're lagging, of course. The volatility index, I mean, it closed this week at 12.07. It was dropped about 15.3% from the prior week's close. Just a little bit more, and we're going to be below the 12 handle, which to me is just truly amazing. World markets, we've seen most of them up as well. The Hang Seng in Hong Kong, we're following that closely. It was up 2%. China was about flat. The Nikkei was up a solid 2.3%. DAX another solid 2.06%, and the CAC 40 over in France up 2.22%. And then for the performance for this past week, the best performing sector was materials. The worst, of course, is utilities, being kind of a bond proxy in the equity market. And we're seeing the trailing PE ratio, PE multiple for the S&P. Coming in at about 22.31. The forward PE for the next 12 months is around 18.6. Now, that represents the forward 12 month is lower than the trailing 12 month by about 16.4%, which we would expect. Although I will say the forward PE is still much higher than the averages going back for some time. I'll talk about that in a minute. And then the S&P annual dividend yield is about 1.88%. And keep in mind, the interest rates now just moved slightly above the annual dividend yield. This past week, it closed up 1.93% for the 10-year U.S. Treasury. So we've seen a pretty big shift go on in these markets. You know, and while we're seeing most U.S. indexes, as I said, closing at or near their all-time highs, we've seen the S&P up for 5 straight weeks, but this move higher is pushing multiples higher as well. And as I said, going back to about 1986, the average PE multiple's been around, I want to say 15, high 14s, low 15, roughly 15. So, if history's any judge, we're going to see these multiples come down just a bit. I mean, the last time we were at this high of a multiple, it was January of 2018, and we all know what happened in February. Had a big push lower for a number of different reasons, but it tended to reset the PE multiple for sure. But it looks like earnings growth for 2020 is coming in around 8.8% forecast. Now, keep in mind, analysts always overestimate forward growth percentages. So 8.8%, we can expect that to come in a little bit. In fact, I'd probably cut it in half to around 4 or something like that. So what this does to me, it seems like a lot of good news has already been priced in the current markets and the price levels that we're seeing. And, that means we can see a little bit of a, kind of a flat market over the next 6 months, although there's going to be periods of FOMO, the fear of missing out, where I'm still maintaining that. And I've had our members kind of prime for that, which is what we're seeing. And the U.S. markets have also outperformed the world markets, this past year by over 25%. So again, that just tends to show that we can have a little bit of a reversion back to the mean, which means some of the other markets offshore, European markets, can outperform the U.S. markets in 2020. So that's kind of at a macro level. We're also seeing, taking it down just a little bit of a notch, we can see sector rotation going on beneath the surface, a lot of it. For instance, this past week, we saw bond markets globally, or actually not this past week, but the past 4 weeks or so. It's amazing. Global bond markets, we had about 17 trillion in government debt that was below zero, negative interest rates. That's been reduced by almost a third, guys, down to 11.9 trillion. Amazing. And we've seen the U.S. 10-year Treasury move from a low of around 1.47 to close this past week, as I said, around 1.93, right? So that's just a huge move. And while yields still remain historically low compared to everything else, these higher moves in interest globally tends to show that the markets are now more open to a growth perspective in 2020, with recessionary fears kind of pulling back a little bit or receding a little bit. Now, this move from a risk off to risk on assets has really been apparent, as I said, in the bond market. For our members, we've made some great money because I was calling out some of this stuff 4 or 5 weeks ago in some longer term trades. I mentioned a few of them here in this free weekly update as well. Some of you guys probably caught it. If you did, you've made some great money on some of those trades. But we're seeing this risk on shift more money into risk on from risk off, and we're seeing, it's also happening in precious metals, um, gold and silver. We're seeing it in the currency market. We're seeing the yen, which is traditionally a risk off sector, coming in a little bit. Also seeing it a little bit in the U.S. dollar. So we're seeing these things shift from the summer months. Okay, I mean, I could see some of these shifts. If you're following a regular listener of these weekly free roundups, you get a good idea from a macro view of just some of the things that are going on right now. For our members, we go in a little bit more micro and look at ways to take advantage of some of these things, and it doesn't guarantee success, but it puts the wind behind us a little bit in some of our trades, right? So far, they're working out very well for us. We're also seeing this underlying shift in global assets. We're seeing rising U.S. productivity numbers, expanding labor force participation rate, and some of the headwinds from the U.S.-China trade tiff are kind of abating somewhat, with recent news over this past week or so of a phase one signing deal is near. I don't really pay much attention to the day-to-day noise that comes out of either the White House or China, but I think it's in both parties' interest to get something signed relatively soon. The algos will hit it, but generally what I'm seeing with the algos is they're less effective now than they were 6 months ago, when some news would hit the wires that Trump's not going to do this or China doesn't want to do that kind of thing. So we're seeing an algo induced fast move down 10, 15 points, and then it pretty much recaps all of the fast move down from that algo driven move. All it's really doing is moving out longs or short stops. That's all it's really doing. So we're also seeing value stocks really relative to growth stocks. I haven't seen this undervalued relationship going back to about 2003, the early 2000s. And anytime we've had something like this big fundamental shift, we've seen value outperform growth by over 30%. So and this also brings in more significance to dividend paying stocks. And for our members, you probably know exactly what I'm talking about, because I used to not talk much about dividend paying stocks, but you're hearing me more and more over the past 5, 6 weeks bringing up dividend paying stocks as an area that's not only underperformed as a value player, but now we're seeing actually some of these turn into growth stocks and yet still paying good dividends. And a lot of you guys may not be aware of this, but going back to 1926, of all the annual returns of the S&P, 40% of them are tied into dividends. So dividends should be some, really hard charging dividend paying stock should be part of your portfolio if you're having a nice portfolio mix. Okay. Now, this coming Monday over in China is another really cool day. We're going to get Singles Day in China, which is similar to our Black Friday. As you guys know, our Black Friday, the day after Thanksgiving, Amazon has a big event and they sell, gosh, I think it was like last year, it was over 7 billion in one day. But that's really nothing to compare with Singles Day in China with Alibaba. They call it Singles Day because it's this Monday, which is November the 11th. So 11/11.11/11. So that's why they call it Singles Day. They're projected to sell over 30 billion in goods to Chinese consumers. The U.S. can't participate in this in a 24-hour period. So that gives you an idea. And for our members, we'll go into details on some ways to play this. But there's going to be some interesting ways that we can play some of these numbers here. So anyway, that's what I'm seeing here. What I've got on the screen that you can see now is a Ichimoku chart. I've put it on a weekly. I show it sometimes to you guys on this weekly roundup here. But if you look at it, I've got a couple of things drawn on here. If you look on the right-hand side, I'll circle it here. I've got Fibonacci extensions off of these lows right here. And I've defined a range of these Fibonacci extensions from the lows made here after this May decline. For our members, remember, we started getting short right in that area there. And then for the August decline, which shows up on this weekly chart here, we were also getting short right in this area here. So we played both of these bounces, but that generated this Fibonacci extension. We came right up and we just about kissed the first extension level at 3,100, call it 3,100. And if you guys remember, I said that the markets can run up to 3,150, right? And that's where I still believe, but not without another pullback, right? So if I were to extend this channel, something like this, right? Now it's not a very not a very well drawn channel, but we could come back here and then make another run up and run up something like that. And that's what I believe is going to happen, sometime over the next 90 days. Now, keep in mind, November, 70% of the time, and the month of December, 70% of the time, the markets tend to close higher than where they started from. So that's a normal occurrence. Last year, December, we fell 10% in less than 21 days. Okay, so that just gives you an idea that you can't rely on stats is a really good predictor on a probability perspective. But as you know, in the markets, it's like trying to forecast, as I always like to say, which side of the yellow line the drunk is going to walk on next in the police sobriety test. You just don't know, right? But this is the higher likelihood move like this, okay? So I put these extensions in here based on this, and you can see also in this chart right here. Let me just kind of take some of this off the screen here for a second. You can also see in this chart we hit nicely our first level of resistance, and we spent over a month there, and then we gave it up in the month of August, right? So after our May downdraft, and then we had the move back up, that move up, I had this target here already set for our folks. Now this target is drawn using e-signal, but all it is a combination of using Gann, which is a time series based thing, as well as Fibonacci, which is price based, and you can use it for time as well. But it uses an algorithm and plots out where we can expect resistance, okay? And then you can see in these small lines here, or these small numbers here, a wave count series, which I find is usually accurate about 65 to 70% of the time. Nothing's 100%, as we all know. And you're seeing here an Elliott wave count of 5, and then there's another smaller 5 up here, which suggests we could have another pullback and then a move higher here that would hit me what I would want to hit, right? So this is one number here. Now, if I were to plot another one of these off the prior 3 Elliott wave 3 leg up, I'll show you where it plots it. Okay, so that would be somewhere in that we would expect it to be somewhere up in this area here. So if I clear the screen off, let me just erase all of this and move over here to go to the prior 3 leg. Okay, and if I come over here and plot this on this Ichimoku like that, now you can see this plots the bigger, harder to pass resistance point. And you can see we're right up in this area right up here, right? And it takes us up to the first level of this Fibonacci series. So now generally when prices hit these areas, the first reaction is to stall out, okay? So the higher probability move is to stall out kind of thing. So it looks somewhat like this stall right here. Now this stall lasted 4 weeks before we finally gave it up in the month of August. Okay, so we've been in this now for a couple of weeks, and we could chop around here. So the probability, the higher probabilities for a stall and then a pullback, which would give us that kind of move that I said, and then allow us to launch higher, allow a lot of this cash sitting on the sidelines to come back in, and then just catapult us up as we finish out year and moving into January. Okay, so that would be the higher probability move. Another way that this thing can go out here, okay, which would not surprise me at all, is that we can move above this level, and then this level now becomes a support, and then we consolidate again for a bit of time before we break out to the upside and come up to this next level here, which is around 3150 to 3175. Okay. Now, there are some analysts calling for the markets to move up over 3,200, 3,300, even 3,400. For that to happen, we need a catalyst for the markets to move higher, okay? And if we've got rising interest rates, as they've been doing right now, That's going to make it harder for the markets to have that catalyst because the multiple, the PE multiple, is going to be harder to maintain. Now, if we do get a China-US trade deal, and it is a good deal, and all the tariffs come off, that gives us the three legs of the bar stool I've been talking about, right? Bar stool leg number one, Q3 earnings come in and they beat. Granted, the earnings estimates were very low. I mean, you know, a drunk could, if you just pass out, you step over the bar. But it doesn't matter. All right, as long as you beat is all that really matters. So that leg was achieved. So Q3 earnings came in good. All right, it's a relative term, but they beat estimates. Barstool leg number two was the Feds. Now we've got a supportive Fed. They've come out and pretty much said they're not going to be raising rates anytime soon. I don't think they're going to be cutting rates anytime soon either. And we're seeing that globally, as I said before. We've seen the global government debt move that's below zero from 17 trillion moved down to 11.9 trillion. That's almost a third of global debt has moved up outside of negative territory. That's a vote of confidence for 2020, guys. And the credit markets, as you guys know that follow me and our user group, credit markets is what you must understand inside and out because it'll be your key to understanding equity markets. It's not the other way around. Understand credit first, and that'll tell you where everything else is going. So this is kind of what we're seeing, what I'm seeing here in this chart. All right, so if I just kind of take everything off the screen here, and then we shift it down to a daily, right? Let me put it on the daily chart right here. So you can see here how we're moving up and we're hitting this first level here. And you can see the cloud in the Ichimoku is well below us. This serves as our support zone, a macro zone coming all the way down to a low of 2,900, which may seem like a light year away, but believe me, you know, if we look at the, you know, some of these pullbacks like here in August, or in September, which is a minor pullback of August, we can move down, you know, and here in September, we moved from 30.22 down to 28.55, right? So that was, you know, about 80 points. So an 80-point move here takes us right down to the 3,000 level right here, which is a natural barrier, right? A water barrier for the markets, if a psychological barrier for a pullback, okay? So anyway, this is kind of what I'm seeing right here. This big area here has more resistance than this smaller area here. And you can see how we hung up here for about a month on the smaller area. So for us to get a catalyst to move much more significantly above this, it would require the China phase one deal to get done and then Trump and Xi to have a happy FaceTime on TV where Trump's taking him to dinner in the drive-thru at McDonald's, Trump's favorite place to eat. And they're both talking about, you know, we're making positive progress on phase two. We hope to have some of this stuff wrapped up in the summer. Hint, hint, presidential elections in the fall. So it just times out well. That if I'm sure that's what Trump is working on from a timing standpoint. As much as Trump follows the markets, we've got to make the bet that that's what he's going to do. Okay. So we never know for sure where price action is going to go, but I've never seen a president use the stock market as a benchmark for performance as much as he has. But we need to put it to our advantage, okay? Whether you like him or hate him or indifferent to him, we play what we see. So this is kind of what I'm seeing here. We've got some nice solid support. Notice also we've got this almost like this curve up in support. So that means as we move forward in time, support's going to get tighter and tighter, okay, from where we're looking at right here. So this is one chart that I wanted to show you. Another one that I wanted to show you, I'm going to go in and I'm going to put it on a Bollinger Band of a daily with the E-minis, and I've got three Bollinger Bands laid on top of each other. So it's kind of like a instead of a typical Bollinger Band, which is, you know, an inner and an outer ring, and that's it. This one has got several on there. So let me just get that screen up for you guys. I think it's screen number 6 here. Now, on this daily chart here, you can also see a couple of things. Let me just kind of step it back just a little. Okay. So one thing I want you to notice here, again, I've got the same resistance point that I got here. I don't need to plot the other one because it'll put us right in this area here. From our all-time highs right around the 3,100, as you know, the fib extension off the prior highs, took us at 3,100. So if I were to plot one of these on here, it would come in right at that level right there, right where we're sitting, just as I showed you before on the previous chart. So now let's look at something here. As we ride up, you can see the ride up here on these Bollinger Bands generally rides between the blue and the purple line. The purple line is a 2 standard dev. The blue line is a 1 standard dev, which is usually not shown on most Bollinger Bands, okay? And then the red line is a 3 standard dev. Very rarely do you get the red line. You generally get it in a down move instead of an up move, but if you do get it in an up move, you want to be interested in picking up some shorts, that's for sure. Even a reversion to the mean could be a nice trade. So if we look over here, as I said, the up move and a nice little momentum move, you generally run the blue line, right? And you run above the blue line and below the purple line. So again, if we look right there, we're above the blue line and below the purple line. So we're getting that nice little move. And of course, when you're here, you're above the center line of the Bollinger Band. Okay, so here we did the exact same thing. We moved above the center line, and now we're moving between the purple line and the blue line. All right, which is normal, but it's a nice momentum trade. You can see on the MACD, there is zero what we call bearish divergence. So that means that any pullback here is probably going to be bought by all these cash hungry investors that are just getting very antsy, having not participated in this move right here. Okay, so any pullback, they're going to be quick to pull the trigger to get into the trade rather than unloading stock. So that is kind of what this chart is indicating to me. Doesn't mean that we can't pull back all the way down to here, because remember that's down to 3,000. So that gives us, from the close, a 92-point pullback. And I promise you, if we get that happening, you're going to have all the talking heads on TV that have been bearish for the past year just fighting this bull market like crazy. I've never seen a more hated bull market. They're fighting the hell out of it, right? And eventually they'll be right. We'll have a bull pullback, but you don't want to be on the sidelines missing out on some of these moves, guys. So, but if this happens where we pull back to this level here, I promise you they're going to be ongoing. See, I told you, they're going to be the first to come out and say, this is the beginning of the massive pullback. We're going to come down. We're going to go into a bear market, blah, 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 all that kind of crap. So if we do get this pullback, I believe what we're going to see is smarter money coming in, dipping their toe in the water, looking for a bounce back up. Okay, so that's kind of what I'm seeing here. So we're going to watch the movement here in the markets just to kind of see. The other thing is, notice the width of the Bollinger Bands. Generally, when the first initial move comes up, the Bollinger Bands are very wide. That means volatility and the range of movement is very wide. And it usually is a result of the previous pullback, right? Then when it starts to run its own course, the Bollinger Bands contract, and then you have an explosion to the downside. And then it moves back up, right? So now we've got a fairly wide band here, which suggests we're going to kind of begin to consolidate a little bit. I don't see any catalyst that's going to just jam us a lot higher, short of any China-US trade phase 1 deal, right? And then that would be an opportunity, I think, if it gets up around the red band, to sell the news and just look for a little bit of a pullback and consolidation until we just see some more economic data coming out. So that's a little bit. I wanted to spend a little bit of time on this, more so than normal, showing you a couple of different charts and a couple of different ways. Both charts are kind of in alignment, saying the exact same thing. So that's a little bit about what I'm seeing here right now. Okay, now if we come over, let me just switch my screen again. Let me come back to my normal, what you guys normally see when I do these things here. So this is just a simple chart here of the E-minis. And if we come in here and we look at volatility, as I said before, I mean, this thing closed at 12.07. So we're well in the green. And when we're in the green, certain option strategies work a lot better than other option strategies that tend to work better when we're in the red. And these are just levels that I put on here so that our members can get kind of a better view of just what types of strategies they should be pulling off their option strategy shelf. If you're really unfamiliar with some of this stuff, folks, you can't make money in options longer term if you don't understand volatility. That's almost a guarantee. You can be lucky, but over time you're going to give it back up. Check out our option masters and get into that, or come into our group, because this will help you guys out tremendously. But if we're looking at volatility and we look at the front month skew, if we look at the front month skew, we're in the green. That means there is a contango environment. That's no fear in the markets. If we look at the back month skew, we're even deeper in the green. These are daily charts. This says there is no concern looking out November and December, which are traditionally our strongest times of the year. So this just indicates to me that until there is a fear-based catalyst, then the markets are just going to grind higher or consolidate around these levels, you know. And it's one of those kind of markets that a lot of bulls that are in this trade, it's kind of boring. You know, it may go up or go down 4 or 5 points during the day, and then vol just continues to drop until we have a catalyst where something just, you know, spikes, and then we see a spike in vol and price action drops a little bit. So that's kind of what I'm seeing. Now look at the bond market. Let me get the bond market on here. This is amazing. If you look at this bond market, we gave up, we're giving up a key level here. Okay, so if I were to highlight this right in this area right there, let me just draw that line. I'll overlight that. You can see we're just now breaking the line. There's a value area sitting here, as I said before, around 154. All right, we're at 156 right now, but we're making a series of lower highs and lower lows, right? So we're now in this channel coming down. You can see the MACD kind of giving us one of these kind of things like this. So that is a descending triangle on the MACD. But up here, it does suggest we could get a little bit of a bounce higher. And if it does, let's get our pirate's face on and go for the booty. I got to give him an eye patch here. Let me put that eye patch on him. So that's what we're going to do, and we're going to sell the heck out of it and watch it come back over again. So that would fit with the macro thesis of the markets right now believe that central banks globally just don't want to cut the rates anymore. Although I will admit Japan is one of the outliers. In fact, their central bank head Kuroda announced that he's looking at cutting rates again. I mean, they're really doing everything they can to get out of their funk that they've been in for several decades, right? But the bond market gave it up. And back in August, right at the end of August, this is when I gave our members some signals on some really good trades that are making really good money in the debt market. So that's a little bit about what I'm seeing there. And you can see the interest rates. If you look at the 10-year interest rates, look at this, guys. I mean, right around these lows down here, 1429, that was the made in September. We've just made a series of higher highs and higher lows. So if I were to regression channel this thing and just put it in here like that, you can see that I wouldn't expect this value area here is sitting right over 2%. If we climb much further than 2%, it could start to put some downward pressure on the equity markets. And again, with interest rates, it's not so much the height of the climb, but it's the speed of the climb. So if we move up really fast, it can spook the equity markets. That would be a catalyst to see a little bit of a pullback, which I would expect, a little bit of I call it a dip, not a pullback. So that's kind of what I'm seeing there, but there's going to be some really great trades across all of these. And then, of course, in currencies, you can see the same thing with the dollar and the euro. If we look at the euro here, again, currencies trend. That's why we like them. You can see this regression channel here. The euro is coming back down in this area here, but it's more likely to catch a stop here. I'd be more interested in going long the euro than short the euro down in this area down here. Same thing with the US dollar. The dollar moves opposite of the euro generally because the euro is about 58% of the value of the dollar index. Remember what I always been telling our members, up in these levels here, we want to short the dollar. Okay, down these levels down here, we want to be long the dollar until this trend changes. So down in this level down here, the bet was more favorable for a long dollar than a short dollar. But I think eventually it's going to start to run out of ammunition up here, and we'll be looking for a short in the dollar again. Okay, and then of course, if we come down here and look at gold, I told you guys with gold, this is the channel that we're in. Okay, and this is the move that we're in. And we're just running this channel down here, this regression channel. And I said that gold could come back down to another value area down here around 1400. All right, we made a play here with gold to the upside. And once we got up into these levels here, we were either taking profits or putting on in the money puts that would protect downside move. Now, I think eventually gold is going to bottom probably around the 1400 level, consolidate for a period of time, and then work its way back up. But right now, you do not want to be long gold. All right, silver is the same way. Now, I got our members in silver rather than gold because if you look at the ratio of gold to silver, the 15-year average is around 60 ounces of silver to make up 1 ounce of gold. Okay. But that ratio got as high as 85. So I said, if we have a big move, and over the summer months, I was expecting a big move, right? I said, let's play it with silver instead of gold. And you could see this huge, massive move in silver. It was a really great trade for us. And then up in these levels up here, we were doing in the money puts. And you could see this profit taking mode right here. We're right in the center of the regression channel here. So I don't think this move is over. There's a value area sitting here right around 1640 roughly for silver. I could see it coming in here testing the 200 EMA at the bottom of this channel. I think it's going to be a longer consolidation period, and then it's going to work its way back up again. Oil, well, oil, I've said all year that the center line of oil is around 55, 56. 55 is the number I've been using. The value area is around 56. But, doing flies in oil, doing iron condors in oil, as long as you manage the outside ranges, oil is not going to go too much over the low 60s and too much under the low 50s, at least for the time being. Keep in mind, we got OPEC meeting in Vienna on December 5th through 7th. I think it's a Friday through a Sunday. They're talking about cutting production more because there's an overabundance of supply compared to demand. But if we get more of the global growth story in 2020, I think we'll see oil start to edge up. All right. Right now, it's kind of a neutral bias for me with the oil markets. Now, there's other opportunities in agriculture that I've talked about with our members on this China deal, as well as meats and softs. But we're gonna, for our members this Sunday, we'll go into some more detail on some of my dividend stock favorites, some of the rotational stuff that I think we can watch here and play nicely. All right, everybody. I hope you guys have a great weekend. I'm going to watch a great football game this afternoon, Alabama and LSU. It proves to be a real crazy one. Number 2, I think, and number 3 in the country. So it should be a fun game. Otherwise, everybody have a really great weekend. Members, I will see you this Sunday night. If you're not a member, I highly encourage you to come in and check us out. We're having a great year. I think next year is going to offer up a lot of opportunity for surprises with the presidential elections and ways that we can play these markets, depending on who's winning in the polls and how the markets are moving. Have a great weekend, everybody. See you guys later. Ciao.